Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Israel vows to retaliate after Iran fires 200 ballistic missiles that were mostly intercepted, while Tehran says its military stands ready. We'll bring you the latest from the region. Traders flock to haven assets, with gold holding near a record, but Hong Kong stocks focus on Chinese potential and continue their rally. Plus, Prime Minister Michel Barnier delays plans for France to meet its budget deficit target. We'll bring you details ahead of Bloomberg's panel with President Emmanuel Macron later today.
In the meantime, a quick check on these markets here. You are seeing green on the screen when you look at the futures picture, but only marginally higher by 0.2% on Eurostoxx 50 futures. A similar margin for the FTSE 100, but Anna, it's that rally you were really talking about. The green on screen in China does continue, especially in the Hong Kong shares, given the Chinese markets are closed. And of course, one eye on Brent crude with the Middle East tensions as well, higher by just shy of 2%. The countdown to the opening trade starts right now.
October 2nd. Good morning. There appear to be two distinct buckets of news this morning that you need to think about as you sit down at your desk and try and figure out what this day is going to be ultimately looking like. You've got the Iran-Israel bucket of news, and I think we can probably put the US vice presidential debate into this. Oil prices are higher. You've got the dollar up as well. You've got haven assets doing well. Anna was mentioning what is happening with gold. So that's kind of one distinct bucket. Then you've got the China story. Now, China's closed. We've got the holiday ongoing. But take a look at what's been happening in Hong Kong. I'm not too sure that these two asset price reactions have anything to do with each other. If you were going to draw a line between the two, it's probably via the inflation tail and what is going to happen globally to the inflation picture. And I think we need to keep a careful eye on that. But, Anna, this morning, it does seem as if we've got two very distinct stories unfolding. The Iran story is obviously one that we're watching very carefully, but the China rally continues strongly.
Yes, there are things we keep on our radar because in the past they've had the potential to move assets. They do move assets, but sometimes that movement is short-lived and therefore the markets move on quite quickly. And there are other things that we watch because of their long-lasting impact. And I suppose the China news flow falls into that. If we linger, though, on the former, and that's some of the news flow that we've seen out of the Middle East over the last 24 hours or so, I mean, crucially, we move on to thinking about reaction from Israel now. And I guess what I'm thinking about here is how much is this like April? If it's like April, then we saw the market reaction. The markets were nervous. In April, it happened at the weekend, so that was a little different. But markets were nervous, they were jittery. We saw a flight to safe havens. But then we saw things unwind pretty quickly, as it seemed as if parties there were not trying to escalate in the end and trying to draw some kind of line in the sand. I'm not sure we're in quite the same situation there now, and therefore we continue to monitor.
We absolutely do. When it comes to the market reaction, which you had mentioned on the Brent crude story, at the time, the average kind of deviation that you saw on those geopolitical headlines go up to 4 or 5% on oil. We've seen a blip just this morning, just shy of 2% on the oil price. And I think that tells you something because we're still concerned about, yes, an escalation. What does that actually mean for the supply side story? Is it a potential strike on Aramco fields? Is it a potential does it mean something for Iranian barrels that hit the market? Let's bring in Jumana Bersechi, our Dubai correspondent, of course, in the UAE. She's, of course, covering the story very, very closely. Jumana, bring us the latest from the region.
Yeah, Kriti, and I'm going to pick up on the conversation that you and Anna were having about the response to the markets, response in the markets to that April series of attacks. But first, let me just walk you through the developments. At around 7:30 p.m. local time, Israeli military said that around 200 ballistic missiles were fired from Iran into Israel. Explosions were reported across central Israel. Now, most of those missiles were intercepted, causing limited damage, though there are reports of one person on the West Bank who was reportedly was killed. But Iranian state TV are still claiming that these strikes targeted important security and military sites, even though these missiles were mostly intercepted. Now, this, of course, is the response from Iran to the killing of not just Hassan Nasrallah last Friday in the airstrike alongside a senior IRGC commander with him, but also to the killing of Ismail Haniyeh, which happened over a month ago. They had been saying for a while now that they were seeking retribution for those events. And indeed, the response has come. Now, in terms of how this differs from what happened back in April, to pick up on the conversation that you two were having, first of all, this time around, the event was much less telegraphed than it was back in April. The US and Israel had much less time this time to, ahead of the fact in terms of preparation and in terms of their ability to actually respond to it. Now, even though most of these missiles were intercepted, the fact that it was less choreographed is a point worth making. The second thing is that the types of missiles that were used this time around were ballistic missiles. They are faster moving missiles, more potent in their efficacy than some of the slower moving missiles and the drones that were used back in April. And so there is a gradient of escalation this time in terms of Iran has chosen to attack Israel. Now, the question from here is how Israel chooses to respond. We heard from the Israeli Prime Minister Netanyahu yesterday. He's saying Iran made a big mistake tonight and it will pay for it. And reporting coming through in the last hour from Axios suggests that a retaliation will come soon.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Jumana Bersachi for us out in Dubai. We thank you so much. Of course, Anna Guy, this was a topic at the VP debate yesterday as well. This is exactly how the debate kicked off. And I think it brings into this broader question of what is the American policy on Iran. That is likely to show up in oil prices. Two very different strategies outlined by the VP candidates. JD Vance, of course, the Republican runner alongside Donald Trump, saying that it's deterrence and about taking that very strong line and the people are fearful of Donald Trump around the world. Tim Walz taking a very different approach, saying Iran is closer to a nuclear deal, a nuclear weapon now than they were during Donald Trump's time, and that steady leadership is the trick there. So two very different approaches out of the States when it comes to what happens next with Iran.
Vance was trying to make the point that there was no major international escalation under Donald Trump's first presidency, that his policies led to peace, I think maybe is an extrapolation of that. Is there an expectation, was there an expectation that is certainly, that's going to be something that carries on into the next one? And I'm wondering what the kind of the policy tools that Donald Trump would pull to achieve that, because that seems to be what Vance was hinting at, that we had this in Trump 1.0, we can deliver this in Trump 2.0 as well.
And we should make the point as well that during Trump 1.0, he, and this is one of the pillars that he talks about in his foreign policy, especially when it applies to some of his approach in Ukraine as well, is he actually claims responsibility for the assassination of the Iranian Revolutionary Guard head, Soleimani. And that is something that he continues to quote as kind of his success in the Middle East.
Yeah, I mean, I suppose zooming out from the individual policy items that they were talking about, which is of interest, the reason I find it interesting, because these are VPs, not presidential candidates, and this is, Europe and not the United States. I think actually what was interesting to me was just the tone of the thing, the fact that it was a little more amicable than some of the politics we've seen on display.
It was policy heavy.
It was policy heavy, for sure, yes, which is something that's been missing from some of the presidential debates. So that was certainly new.
Let's turn our attention to what has been happening in France. So Michel Barnier gets up at the front of the bus yesterday. He's got a noisy rabble at the back of the bus. Everybody's trying to figure out what he's going to say. He gets up, he pulls the map of France out. He goes, we're going to go from here to here. It's going to take longer to get there. It's going to take longer to reach our final destination in 2029. That is now the target for what we are looking at in terms of reaching our budget deficit targets. And roughly we know how we're going to get there. We're going to get there by 2/3 austerity and 1/3 by tax rises. But he gets the map out and he doesn't really give us details as to which way we're going to go. We know some of the broad details.
I'm trying to think.
We are lacking.
In this bus metaphor, I'm not sure what the bond markets are. Bumps in the road or... I don't know, but they didn't move much.
The bond market's a passenger as well, I guess you could argue, in this process as well, and was quite well...
And when does it take the wheel, then? That's interesting.
Well, when does the bond market take the wheel, and when does the noisy rabble at the back of the bus take the wheel as well? Because there's a no-confidence vote that we're all anticipating at some point. It hasn't been called yet.
And the fact Le Pen's response to the budget, Kriti, was quite positive, is material.
It is material. I'm waiting for the bond market to price in some of this taxation cut as well. And I think it's an important piece to mention that France has the most dependence on that tax revenue in all of Europe. 49% of their revenue is coming is a tax revenue as proportion of GDP as of those 2022 numbers. That is a big deal because now the tax conversation is far more relevant in France than it is in the UK, in Italy, in Germany, etc.
Later in the day, we're going to carry on the conversation, talk more about France. Stephanie Flanders is going to be hosting a panel in which we are going to be hearing from the French President Emmanuel Macron. It's going to be happening at the Berlin Global Dialogue. It's an exclusive conversation. It happens at just after 2 p.m. UK time. It's fascinating to see that it feels like Barnier is not Macron's man, and certainly Macron feels like he's got a more tenuous grip on this whole process. What else we've got coming up in the show? Let's talk about some of the big news that we're watching this morning and the reaction we are going to be seeing to it. We're going to get reaction to Barnier's agenda. Carmagnac's chief economist, Rafael Gallardo, is going to be joining us. We're going to get a commodities check. We've seen big moves over the last 24 hours. Trafigura's Saad Rahim is going to be joining us. William Davies, global CIO at Columbia Threadneedle, is going to walk us through the market action. And at 8:30, is there a path to de-escalation in the Middle East? Julian Barnes-Dacey from the European Council on Foreign Relations is going to give us a take on what we've seen and what we are about to see potentially on the geopolitical story.
Some fascinating conversations ahead on the show. Here's what else to watch out for today, at least when it comes to the trading agenda. 10 a.m. UK time, that euro area unemployment is going to hit the wire. 12 p.m. UK, it's that U.S. mortgage applications. There's a lot going on there. And, of course, the ADP employment numbers, what we've really got our eye on ahead of the payrolls report on Friday, 1:15 p.m. UK time. But then plenty of central bank speak on both sides of the Atlantic. Bowman, of course, the hawk in the Fed, as well as Barkin speaking in the ECB's lane, Kazak's Elderson, and, of course, Schnabel.
So many ECB speakers, 5 at least. And some of them
Fed speakers
some of them speak twice, you know, so there's a lot of action on that front. I'm particularly interested also in Starmer, UK Prime Minister Keir Starmer's visit to Brussels. He's going to be meeting with Ursula von der Leyen, and this part of the UK's attempt to reset the relationship, even a tone change and a mood shift, as you know, it might be something to watch here. But the UK has a list of demands, the EU has a list of demands. They don't meet in the middle necessarily, and so we'll see whether this actually, in the end, produces anything. But the fact they're talking and things look friendlier is a positive.
Starmer wants British pop bands to be able to tour on the continent.
Yes,
nice
this is important stuff.
This is important stuff.
Yeah.
He wants some sort of veterinary deal getting done. The EU wants a deal for the 18 to 30s. The UK is very wary of that because of the immigration story and is worried that if you start opening up free movement, you could see large numbers of people coming in, which is going to affect the numbers, which they promise will come down.
I saw that the EU also had on their list the F word, which I mean fisheries, which can, you know...
I think you could, yeah.
That gets difficult pretty quickly, so we'll see where that one takes us.
It does.
What else we need to know this morning? Let me update you on that. BMW pressing Berlin to vote against higher European Union tariffs on Chinese-made EVs, joining other German car makers that don't want to upset their most important market. BMW CEO is arguing the increase could provoke a trade dispute benefiting neither side. EU member states are set to vote on the plan on Friday. Samsung is laying off workers in Southeast Asia, Australia and New Zealand in a plan to cut thousands of jobs worldwide as it struggles to compete in the AI market. Shares of the world's largest maker of memory chips and smartphones are down more than 20% this year. And Nike shares have extended declines in after-hours trading. This after the sportswear giant withdrew full-year guidance. The company reported a 10% fall in fiscal first quarter of revenue, just short of average estimates. But its China business was a bright spot with Nike's gross margin and sales exceeding expectations. That read didn't talk about the fact that we've got a massive management change that is taking place here. The current CEO wasn't on the call. Got a new CEO coming in. There's a massive reset coming up. We don't really know what that reset's going to look like. So I think you can park those numbers that we saw yesterday.
Yes, and we did see negative reaction, but it was maybe not as much as you might have expected if there had not been already a management change in the offing. They cancelled their capital markets day, removed the guidance, never looks good. But as we know, yes, new hands on the tiller soon. The fact that China was better than expected, is that going to be the thing that reads across positively into Adidas, or is it going to be something else to do with the rest of the global business, which did seem to be struggling more?
This is important. About 13% of their revenue comes from the APAC region and specifically. And what I think is so crucial about Nike is that from a U.S. stock market perspective, Nike, Starbucks, Microsoft, the ones that have really big exposure to China relative to some of their peers, are the ones that are kind of traded on that China trade, especially around elections. So keep an eye on the Nike stock. The other one to keep an eye on as well is simply the fact that the shipping costs are showing up are going to be passed on to the consumer in Nike products. It has happened in 2020, 2021. With the port strikes going on, it could show up in Nike products again.
Does a more buoyant Chinese consumer start to lift some of these stocks in a more meaningful way going forward? Are we going to see the China rally reading across into names like Nike?
Well, yeah, and anything they've reported, of course, is backward-looking and predates any stimulus. So, is there more to play on the China story? And maybe that's where the likes of Adidas and Puma come in. We will continue to keep across that story. Coming up on the programme, we'll check in with our Middle East Bureau to stay across the latest tensions in the region and on commodity price reaction, of course. Plus, we hear from the head of Adnoc's downstream business on his company's acquisition of the German chemicals company, Covestro. Covestro. Up next, France has a budget preview from Prime Minister Michel Barnier. We will check on how markets are reacting. If you have any questions, if you want to get involved in our guest conversations, please do send us a message. Use the IB plus BBTV Go function on the Bloomberg terminal. This is Bloomberg.
Is it acceptable that we spend more money on paying interest to others than we pay for our own defense spending and research? My answer today is no. Confronted with our immense challenges, we don't have the choice. Our responsibility is to weaken the burden and get back margin for maneuver with the budget.
That was the French Prime Minister Michel Barnier, of course, speaking to the Assembly, speaking about his plans for the French economy. Let's bring in Raphael Gallardo, Chief Economist at Carmignac Gestion, who joins us now from Paris. Raphael, very nice to speak to you. Was there anything material enough, any detail enough in in this statement from Michel Barnier to move the conversation on in France? I see that spreads between French and German debt didn't move all that much on these words.
Good morning, Anna. Thank you for having me. Yes, I think what really struck me was, on the one hand, the lack of ambition, saying that we're going to let the deficit broaden to 6% this year, and then we will bring it back to 5% next year. But it was really lacking details on how they want to achieve this. So the market is still giving him the benefit of the doubt, but very clearly we need to see concrete measures on how he wants to tackle the issue.
So we need to see some more concrete measures. And we have a bit of a sense of where the heavy lifting is going to be. 2/3 of it coming from cutting back on spending and 1/3 coming from higher taxes. Yeah. And the initial reaction from Marine Le Pen, who seems important in this because her tacit acceptance seems important, she clearly didn't object. Is that the audience that he's playing to when he comes up with that balance?
I think so. The problem is that the slippage in spending in France, it's coming from pensions and also local government spending. And Michel Barnier doesn't have control over this. On the contrary, he said he's going to reopen the debate about the pensions. And we know that Marine Le Pen is favorable to completely unraveling Macron's pension reform. So on this, there is a lack of credibility. On the other third, which is hiking taxes, France is already a tax hell for corporates and wealthy individuals. And if hiking taxes even more was a solution, France would be the best rated country in the world. So it doesn't seem credible, but Barnier is dealing with the hand he's been given by this assembly, and notably Marine Le Pen, who will oppose some form of drastic austerity on spending. So he's really on a very tight leash from Marine Le Pen to try to manage market expectations and European expectation, while at the same time avoiding to create a coalition against him by the far right and the far left. So he's really trading a very fine line between the two evils.
Raphael, it's Kriti in London. I want to dive into that tax conversation more. What is the threshold for more pain when it comes to economic growth for some of this taxation? We're looking at about 8.5%, I believe, was the number that was floated as that tax rate. What is the threshold for that to do some real damage to the economy? Well,
we know that Europe is only asking us to do 0.5 percentage point of reducing the deficit. 1 percentage point will be much more difficult, particularly if growth weakens. And so far, we had this slippage in the budget this year, despite growth being roughly in line with expectations by the government. But the problem is that most growth came from exports, which are more likely taxed, but mostly from fiscal spending, public spending by local governments and the central government redistributing welfare benefits to the population. So the engine of growth will be attacked very quickly. So I think this austerity will be painful, and we'll see how the electorate reacts to that and how the parties react to that. So it's a very tricky situation for sure. Yeah.
So then the other aspect of what hits the underlying growth picture is what's going on, of course, in the bond market. Bloomberg Economics put out some insight there saying that there would be a 0.5% hit to French GDP if spreads stay wider by about 30 basis points into 2025. Do you agree with that number?
Roughly, it's in the ballpark, but I guess the French economy has been kind of getting away with fiscal murder for a very long time. And so I think it's a kind of a healthy wake-up call to tell us that we need to straighten the ship very quickly if we don't want to get into much more troubled waters where we will be forced to do austerity in the middle of a recession under a much tighter external constraint. So at roughly 80 basis points, yes, the debt burden will increase. The interest payment will be much harder for the budget. But I guess this is the only way to discipline the French political system into respecting intertemporal solvency and respecting our European commitments.
Raphael, what's your degree of certainty that France will have a budget deficit of equal to or less than 3% in 2029?
I would say not much. The problem is that France has been the champion of always delaying the time when we reach the 3% deficit. And remember that for Europe now, the threshold is no longer 3%. You should be aiming for 1.5%. But the starting point is 6%. And I think it was kind of a trick by Barnier to say, we don't put out a new fiscal law for this year so that the starting point is going to be 6%. And then we'll sell to Europe, look, we're doing the minimum that you request from us, which is to adjust by 0.5 percentage point per year. So that will make it even easier to reach the European target of doing the minimum adjustment year after year. But reaching 3% from our current position is going to be extremely difficult, particularly when we know that inside the country, politically, there is zero consensus on how to achieve this.
Is Barnier going to be in the driver's seat for long? We're waiting for the no confidence vote. What are you hearing in Paris? What is the expectation in terms of how long this administration will be in place for?
Well, our expectation is that everybody has an interest to keep him in the driver's seat until the next presidential election in 2027. We could have a snap election. Constitutionally, it's possible to have one next July, but the opposition parties are not ready for that. So there is kind of tacit consensus that we let do Barnier some of the dirty job, but not go far enough to infuriate voters from the far left or the far right. But we see that Barnier knows that, and he's being very prudent with his fiscal ambitions, saying that I guess maybe I'm more confident that 1/2 of the adjustment will come from increased taxes, which is not. I mean, it's not guaranteed that it will yield any more tax revenues because the level of taxes in France is already beyond the optimal point of the Laffer curve.
Yep. We will wait the budget next week. Raphael, thank you very much indeed. Raphael Gaillard, Chief Economist at Cognac Gestion. Thank you very much indeed. Don't forget, Bloomberg's Stephanie Flanders hosting a panel with the French President Emmanuel Macron. That conversation coming from the Berlin Global Dialogue a little bit later on. I want to leave you with a live shot coming out of the Middle East. The IDF is warning residents of additional South Lebanon areas to leave their homes. We'll keep an eye on that and the oil price next. This is Bloomberg.
Israel's ability to be able to defend itself is absolutely fundamental. Getting its hostages back, fundamental, and ending the humanitarian crisis in Gaza. But the expansion of Israel and its proxies is an absolute fundamental necessity for the United States to have the steady leadership there. You saw it experienced today, where along with our Israeli partners and our coalition, able to stop the incoming attack. But what's fundamental here is that steady leadership is going to matter.
Diplomacy is not a dirty word, but I think that's something that Governor Walz just said is quite extraordinary. You yourself just said Iran is as close to a nuclear weapon today as they have ever been. And Governor Walz, you blame Donald Trump, who has been the vice president for the last 3.5 years. And the answer is your running mate, not mine. Donald Trump consistently made the world more secure.
Republican vice presidential nominees JD Vance and his Democratic counterpart Tim Walz, they're sparring on the Middle East during their debate last night. Now, Israel's Prime Minister Benjamin Netanyahu has vowed to retaliate after Iran fired about 200 ballistic missiles at the country last night. The barrage started only hours after the U.S. warned an attack was imminent. The Israeli army saying that many missiles have been intercepted, with reports that one person was killed in the West Bank.
Iran made a big mistake tonight, and it will pay for it. The regime in Iran does not understand our determination to defend ourselves and our determination to retaliate against our enemies.
The Revolutionary Guard and Iran's armed forces are ready both defensively and offensively to repeat this operation with multiplied intensity.
The oil price reacted before we saw the attack coming through. There was some warning, but little compared with the previous attacks we've seen coming out of Iran. We are currently up on the session by 1.6%, as you can see, though, now trading at 74.73. Given the potential shifts we could see in the Middle East, is the oil market still being complacent about those risks? Let's try and answer that question. Saad Rahim, chief economist at Trafigura, sitting around the table with us this morning. It's Metals Week in London, that's why you're in town, but let's talk about what's happening with the energy space right now. Let's try and answer that question. Is the oil market still underpricing the risks of this conflict?
Well, I think this is certainly not what we thought we'd be talking about this week, but here we are. I think what we're looking ahead at to say no one really knows how far this could spread, right? What is the reaction now from Israel? What is the counter reaction then from Iran? Do other players start to get involved? I mean, if Israel really starts to then hit oil facilities in Iran, that takes production offline. Do other countries then need to step up to produce, those barrels that are out of the market? And again, how does then Iran maybe start to react to that as well? So I think this is very much, a movable feast right now. And I think anyone who knows exactly how this is going to go is probably deluding themselves. However, having said that, something our global head of oil, Ben Luckock, says a lot is that the market has gotten very good at forward solving problems over the last little bit. I think, we've seen really since October when the conflict started that when you would normally have had missiles going across, a tanker on fire in the Red Sea, the type of heightened tension that we've seen, that oil would be much, much higher than maybe where we are. So I don't know if it's complacency or as much as saying, look, that there are some solvers and we just don't know where this goes.
One of the reasons for that may be that there's significant spare capacity in the world right now in terms of the oil market. But unfortunately, a lot of that spare capacity exists within the Gulf, which is within the sphere of influence, obviously, of Iran. Are we underestimating? We're assuming that spare capacity will be there if there are any restrictions. Is that now being called into question?
I think that's the risk, right? Is that, as you say, all the spare capacity really sits there. And so if there is something that starts to disrupt the flow out of the Straits of Hormuz, like what we've already seen on the Red Sea side, now you don't even have that as an outlet because of the disruptions there. So I think that creates a potential problem. But, for as long as I've been in the oil market, the disruption in the Strait of Hormuz has always been the key risk. But I think it is, is logistically very difficult. And I think at that point, obviously, you start to get other players involved. The United States, maybe even China starts to say to Iran, that this is not something that we can have where oil then really starts moving much, much higher. And again, at this point, is it in Iran's interest really to disrupt the Straits of Hormuz? I mean, it does internationalize the conflict, make, the costs broader. But right now, Saudi, UAE are saying, look, we have no part in this. And so why would you go after what we're doing?
So the Straits of Hormuz, we watch that carefully for oil, of course. LNG coming from this region, is this also something that we keep in focus? We saw headlines just this morning around gas prices going a little higher this morning on the back of tensions. They didn't yesterday, though, interestingly enough. I mean, what should we watch in terms of that traffic, which is important from that region broadly into Europe?
Oh, no, absolutely. I mean, I think if you start to see LNG shipments out of Qatar being disrupted, I mean, that has global implications, right? That has implications for China, for India, and absolutely for Europe. We were already looking at what was maybe a relatively tight LNG market next year. If you disrupt these flows, I mean, this is, again, very much like the equivalent of what would happen on the oil side. Yeah. So really, there isn't an upper limit on price if you start to really get these commodity flows disrupted.
Yes, I imagine this changed the mood a little at the conference that you were at this week, then, Saad, because I think there'd been quite a lot of optimism within the commodity space about what we'd heard from China just last week. I mean, how game-changing is that commentary from China? Either what we've heard already or what could still come from China, which is where the emphasis that some people put on what we heard last week.
No, I think that's right. I think, really two good rules in markets are probably, number one, don't fight the Fed, and number two, don't fight the Chinese government, right? And I think people have been very quick to fade some of the measures that we have seen talked about. But if you look at it, this is really, in a sense, their Draghi moment of whatever it takes. So it's not even what they've already announced, but I think it is the intent as well to say, look, we can do another batch and another batch after that to try and address the underlying issues here. And if you add it up, I mean, we're talking something like 4 to 5 trillion RMB. Which, we get sort of inured to these large numbers, $1 trillion here, $1 trillion there, but this is still large enough to move the needle. And you can see that, you look at the property developer shares today up 200%.
Yes.
Right? Can you recapitalize some of that and start to rebuild or build some of the inventory that you've sold but not built?
Yeah, the idea of this being the whatever it takes moment for China is something that Ray Dalio was talking about, Kriti. Yeah. We saw him in the last 24 hours putting out some commentary and making that exact point that Sand's just saying. It's not necessarily what's been promised so far. It's what this signals about their intent and where they could go from here.
I love you said don't fight the Chinese government, because it feels like that was also part of the reason that we saw a recovery, perhaps the GFC as well. But I'm curious how the U.S. election plays into all of this. In just the last 24 hours, we heard from 2 of our vice presidential candidates talking about what energy policy out of the states looks like, not just in terms of oil policy, but LNG as well. Is that help cushioning some of the geopolitical premium in these prices?
I think there is some of that, right? I mean, the U.S. has been the solver over the last, really since the Arab Spring, right? So when, we had the Arab Spring, we saw U.S. oil production really start to go up, and that helped offset, what were some major outages, right? And we still have parts of the world that are still offline. If you look at Iran, you look at Venezuela, not back at full capacity. So that U.S. shale production growth has really been the offset there. And so the question is, if you start to limit that, which I don't think that they're really going to do, but, that's really where we have that cushion. Now, U.S. shale growth is certainly slowing down. Yeah. I don't think we're growing at 1 million barrels a day again. But, that now maybe is putting a bit of a floor as well under prices looking forward there.
Does the U.S.'s Iran policy matter when it comes to the way you trade commodities?
I mean, I think it does in the sense of, we saw a lot of movement, a lot of volatility around this back in 2018, where we had the removal from the nuclear deal, but then we had the set of waivers and, kind of the back and forth on that. So knowing, who you could trade with, which barrels could be moved, how could they be moved, right? But then you also had the emergence of what we call the shadow fleet, right? How much oil is being moved around, how much is being ship-to-ship transfers, how much is being, rerouted through other areas. And that has actually had quite a bit of oil added into the market. So, under President Trump, you took a lot of it out, but under President Biden, you have seen some of those barrels come back in. Iran may be exporting about, 1.8 million barrels a day versus where they were, prior to that. Gasoline prices are low. They're low in the United States. That's obviously giving the consumer a quite nice boost at the moment. Is that going to continue? How quickly could we see a shift higher in gasoline prices? Could that happen this side of the election, do you think? And how fat do you think the inflation tail risk looks like right now? I mean, to take the last point, I think the inflation tail risk looks much higher than what the market is pricing, right? And it's not just gasoline, it's across everything else. If you look at it, we're in a U.S. economy that grew 3% last quarter. Atlanta Fed has it now above 3% for this quarter as well. Very low debt obligations, and you're now adding major rate cuts on top of that. And, if both China and the U.S. are doing stimulus, on both monetary and fiscal, that's a huge boost to growth everywhere. Now, gasoline prices also, I think that's an talked about story, right? In the sense of the drop in gasoline prices, even from $3.50 to where we are today, is $50 billion a year back into consumers' pockets. And a lot of that goes into the lower quintiles of income. So the people could really use that boost right now. And if we continue down below $3, you could look at it and you say refining margins are pretty weak. We have a lot of capacity. Could you drift below that? I mean, we're talking about $100 billion potentially that goes back in, on top of now rate cuts. So that inflation risk to me still is very much there. Okay, so the inflation risk maybe comes from consumers having more to spend. What about the inflation risk from and maybe this is sort of advancing into other people's territory a little, but I'm sure you think about this, Sad. The inflation risk from how the US economy responds to higher energy prices these days as compared to, this is not the 70s. The reaction functions to the oil price is different now. There are, for all the headlines about EVs not selling, there are way more EVs than there used to be. So how responsive is the inflation data out of the US, I suppose, to the oil price these days? How much of a hold does it have over the US economy? Well, I still think the largest indicator or the largest determinant of inflation expectations remains gasoline price, right? We always say it's the number one price that people see every day in 10-foot high letters. So, you always say people don't know their ATM PIN number or their anniversary, but they know to the cent what the price of gasoline is.
They probably don't know how much they pay to recharge their electric vehicle
either. Exactly. So, if gasoline prices are going up, I think that has a big impact on at least inflation expectations, even if the share of what they're spending is lower. So I think that's really something that the Fed in particular is going to be watching, even if it doesn't flow through into core inflation.
I want to end the conversation where we started, and that is, of course, this conflict in the Middle East. You made the crucial point that the Saudis and the UAE are staying away from this conflict by design. But in the past, in previous iterations of these tensions, we have seen the Aramco oil fields under attack from the Houthi rebels in Yemen. And I'm curious if that's what gets this geopolitical premium back to the levels we've seen in previous years. Is that a risk you're watching?
I mean, it's absolutely a risk. Again, as we said, we don't know where this could go. We don't know which missile could land in which area. Certainly an attack directly again on the Saudi oil fields, that would be significant. But even that, if you saw it last time, prices spiked at the open on the Monday and then drifted off from there.
Yeah.
So we've seen that time and time again, even with the Russia issue, right? March 7th, you had this big spike, and then prices just drifted off. So again, this idea of forward solving these issues, right? Maybe you're just, you keep doing this until you can't, and then that's maybe when we get the real spike that goes up.
Yeah.
But again, who knows what that's going to take?
A 4 to 6% jump a couple years ago is not certainly what you're going to see this time around. Saad Rahim will lead the conversation there, chief economist over at Traffic Bureau, joining us around the table this morning. Coming up on the program, we're going to head back to Berlin for an exclusive conversation with Bank of America International President Bernie Mensah. That coming up on the program next. This is Bloomberg.
Welcome back to the programme. This is the opening trade. 15 minutes until we get that opening trade. The futures picture suggests a slight uptick, but US futures point a little lower this hour. Now it is day 2 of the Berlin Global Dialogue. Bloomberg's Tom McKenzie is standing by with an exclusive conversation. Tom.
Anna, thank you very much. Yes, very pleased to say I'm joined by Bernie Mensah, the Bank of America International President, here in our Berlin studio at the Global Dialogue, the Berlin Global Dialogue. Bernie, you obviously have a touch point, given your role, on the global economy. And I want to get your sense as to whether or not, given the risks that we're seeing, whether it's the geopolitical risks, what's happening in the Middle East, whether it's the slowdown here in Germany itself, the political risk in the US, whether markets, given that they're at close to and around record highs, whether there's complacency in these markets.
Thanks, Tom. Thanks for being here and thanks for having me on. I'd love to speak for all of the markets. Look, my sense is that I think the markets are tuned to all of the different things that are taking place, and there's a lot of things going on. So depending on the sectors that you're in, depending on the economies that you're focused on, I do think that the market is trying to be alert to events that are happening on the horizon. There's reasons in each of the pockets for where the markets are. You take one market, if you take the broad foreign exchange markets, then the broad sort of DXY currency index, you've seen a sort of a dollar weakening versus the euro a little bit versus sterling, and you can make some arguments for that. So I think the market is poised for challenges that are ahead.
The monetary policy is supportive now that we're in a rate cutting cycle. Rates obviously at relatively historic levels in terms of the highs, but they're moving lower. Do you think the ECB here in Europe, the focus on the European Central Bank, given the soft data, particularly out of Germany, does the ECB need to be more on the front foot? Do they need to cut more aggressively? There's a lot more being priced in for the Fed than there is the ECB right now.
It's an interesting point. I think that the ECB is probably taking into account what the underlying trend growth is. And the markets have got it wrong in the past in terms of how aggressively they thought that the US should cut. And actually right now, if you saw Chairman Powell's speech the other day, there was a slight reference to what his thought the path of or pace of cuts might be versus where the market is. I think with respect to Europe, they'll be looking very, very closely at the underlying growth rates, looking at real rates here versus the US. And I think it's reasonable for them to look for a little bit more data. I think for Europe, the underlying issues around sort of trend growth and accelerating that are the issues that really should come to the fore. And sometimes I do feel that in the broader economy, we rely too much on the central banks to sort of save us.
Okay. Larry Fink of BlackRock saying that the markets are getting ahead of their skis, to your point, in terms of the extent, the number of cuts being priced in by these markets. Would you agree with that sentiment?
I think one of the things that we need to bear in mind is, apart from real rates, what is the terminal rate going to be? What's the underlying rate of inflation going forward? And there are bits of the market that do assume that rates will trend back to where we were sort of pre-COVID or soon after that. And one of the things that we all need to think about over the next period of time is, with all of the different things going on around the world, are we going to end up maybe a point, maybe 100, maybe 150 basis points above where we were in terms of what the terminal rate should be?
Is that your best guess right now? You don't think we get back to a terminal rate, a pre-pandemic terminal rate?
I personally have been worried about just the underlying inflationary pressures that are out there for a bunch of reasons, whether it's COVID, whether it's supply chain moves, and the inflation shocks going through the economy. We have the port strikes in the US that are happening now, and we have increased wage demands, frankly, across the piece and in different parts of the world. So when you factor all of those things in, and when you see some of the other large industries in transition, we're in Germany and talk about the car industry, for example, my instinct has been that all of those things add inefficiencies in the system, and as we're moving to a different, perhaps, type of globalization, that we might find that the underlying trend inflation rate is a little bit higher than we had that before.
Is Germany headed for a prolonged slump, do you think? How concerned are you about Germany?
I'm not in that sense. No, I think the German economy is underlying incredibly strong. The underlying talent is there. And actually, Germany has had quite a lot of investment over the last year or two in terms of large global companies coming and setting up investments and manufacturing activity in Germany. So I think in that sense, there's a lot of reasons to be encouraged and to be attracted to invest in Germany. There's a lot of decisions that need to be made from this point forward that could reduce or increase trend growth. And I think there's a lot of reasons why, with the focus of the German establishment, that can't be achieved.
And I wonder if China will be supportive in terms of moving the dial on German growth in the years ahead, given the stimulus that's come through. What is your take on what we've seen from Beijing? What are you telling clients? How are you advising them to get exposed to the China story, if at all?
Yeah, well, I think that has been quite a meaningful move. I've been watching that as much as I can, a little bit from afar. I spent many years in Asia, so I have a little bit of a sense of some of the dynamics around that. It hasn't been for a while, so I'm not as close to it. But I do feel like it was a step change from a monetary point of view. The size, the funding of share buybacks from companies, a sort of version of a Chinese TARP in the sense of the ability to fund against assets that are not trading at par. So that's all been quite powerful, and the market has reacted immediately. And I don't know. I wish I was in the room with the decision makers, but it feels as if from afar that there's a step change to sort of say, look, if a little bit to your question before with Germany, if we don't take real action, we might be in a prolonged period of slower growth. Now, what the market is saying is, does that get accompanied with fiscal policy, with actual moves to drive underlying, consumer demand? I think that the Chinese government probably had a little bit, or the monetary policy had a little bit of a window, because with the US cutting, remember, it's still a capital account that is closed. They have to watch the exchange rate there versus the dollar, and I think they had a window, and that might affect it.
What is client activity looking like right now?
Well, very immediately we can see it in the market. So everybody's been underweight the Chinese markets. I think some of our own research suggests that it was the second, top three consensus trade. One is long, the tech stocks that we all like to talk about, and the other is being very underweight China. So if you are a global asset allocator, you have to pay attention. You might pay attention and decide that you want to stay underweight, but you're having a decision.
More broadly, are your clients putting more cash to work, or are they still sitting on the sidelines?
Well, you've definitely seen some cash going in. So not just in the indices, but I think in this news organization and others have had some of the large global investors come through and talk about how you need to sort of all in, as it were. So at the margin, there's money going in. Yeah. I can't say exactly how much. I would have thought so. But I think that this was the first initial reaction. That the question is, over the next month or two, does the sort of slightly slower, longer term money reallocate, and then you'll see some momentum
Bernie,
to it.
before we let you go, the Middle East, of course, in focus right now. We have the human toll, of course, which is a priority in terms of how we think about what's going on. What do you say to your clients in terms of how they mitigate the risks around what's unfolding in the Middle East?
Well, as you say, the most important thing is our people, our colleagues, our clients, and everybody else in the region, and just the tragedy that has been going on. And we all have to be concerned to make sure that ends up as in as good a place as possible. The discussion has tended to be what was the impact on the global economy, and there hasn't been as much so far. And earlier we were having a discussion as to whether that might change, and who knows? Sometimes in the markets nothing happens, and then there's a tipping point. I think we all need to do whatever we can in our small way to help, but I do think that we need to watch out for. Just watching the situation and just seeing how it might tip into the broader economy and impacts around that.
Bernie Mensah, thank you very much indeed. Bank of America's international president. Guys, back to you.
Tom, thank you very much indeed. Tom McKenzie joining us in our Berlin studio. The conversation will continue throughout the day. The dialogue will continue in Berlin. And we've got some great conversations coming up from that event a little bit later on. OK. Coming up, the market open. Futures pointing a little bit positive this morning, not by much. Maybe some outperformance we're going to see out of the London market, but not by much. Anyway, we will look at what the China impact is this morning. We will look at what the geopolitical impact is this morning. And we will look at what the single stock impact is this morning as well. Yes, Nike, I'm looking at you there. That's all next. This is Bloomberg. Wednesday morning, good morning. Bunch of things we need to fold into the market this morning, so let's talk about what they all are. You can see the reaction yesterday to the early warning we get that we're about to see an attack by Iran on Israel. Equity markets go down. You can see underneath the white line is the blue line. This happens just around the point at which US markets are opening. We see a big move to the downside. US markets then pick up a little bit as we head in towards the end of the day. That's maybe Kriti why we're seeing futures a touch higher here in Europe this morning.
A touch, but not to the same excitement that we saw over in Asia. And I think that piece is crucial. That risk sentiment is not spilling over into the European session, despite seeing an almost 8% rally in the Hong Kong stocks. A stimulus story continuing to fuel the rally there. But Anna, when you look at the futures picture in Europe, it's still only higher by 0.3%, 2/10 over in the FTSE 100. Underperformance over in the States, paring back some of the green on the screen, perhaps, that we saw yesterday.
Yes, absolutely. So let's have a look at some of the individual names and sectors that might be on the move this morning. We focus in on the defence sector. We saw, of course, a lot of reaction to the news flow yesterday in session. Rheinmetall and Saab, some of the really strong performers yesterday, up by more than 3%, both of those. So we'll certainly keep an eye and see if there's another day of gains in that sector. Sportswear makers also in focus. We heard from Nike. Will it be the positivity around China or the negativity around the overall story that has an impact on Adidas and Puma? Perhaps it'll be the latter, judging by the opening calls we've seen. And Pirelli in focus as well, Guy. This, the tyre maker, of course. Brembo, which is a brake manufacturer. That business has sold its stake in Pirelli, sold its entire stake, or is selling its entire stake. And there had been speculation that these two businesses could combine. So maybe that comes to an end here.
Absolutely. So some single stocks to watch. Keep an eye on what is happening with the energy complex as well. That read across. It does seem as if China feels isolated. Anyway, it is time now for the opening trade this Wednesday morning. Here are the opening numbers out of Europe. The expectation is we're going to see a little bit of upside in the FTSE 100. Does it benefit from the energy complex going higher? Do we see names like Shell and BP doing better off the back of it? There was some evidence of that yesterday. Those names did rise in the session yesterday as we saw crude shifting into a higher gear. The Stock 600 is up by 0.1%. Does seem as if we're not getting that read across out of China, out of the Hong Kong market, into what we're seeing here in Europe in the same way as we did last week. Feels like two very different isolated stories at the moment. The international geopolitical story and what is happening with the Chinese equity markets, which we are seeing through the lens of Hong Kong this week. So there we go. The CAC 40 is open up by 0.3%. The DAX absolutely flat. The IBEX a little bit softer. Kriti, what's happening below the surface?
Yeah, Guy, I think it's exactly the points that you touched on. A lot of that commodity complex is feeding the green on the screen you're seeing in the FTSE 100, but also in the Stock 600 as well, which is interesting because you are seeing an outperformance here in the UK, but not to the same extent I think that a lot of people perhaps expected. Your biggest index contributors, Anna, Shell, BP, Rio Tinto, Glencore, Anglo-American. I think we're sensing a commodities theme here, partially as perhaps magnifying the approach that we've seen in the oil space off the geopolitical tensions. Of course, the China read-through is absolutely there. HSBC nestled in there between.
Yeah, interesting to think about how that China story translates into basic resources. We talked about this a little bit in the last part of the programme, but there is this big conversation about how direct that link is when you've got this property overhang still in that large economy. But energy stocks certainly are going higher today, up by more than 1%. This on the back of, as we know, a higher oil price. 74.65 is where we trade on Brent. Looking for some individual stock names and to see what stands out. We've got Process moving higher. That could be a read across from the Hong Kong trade because it has a big holding in Tencent, of course. BP, as we've mentioned, and Total Energies higher. So there is a commodities sense and a Hong Kong higher sense to what's going on here. There is that little strand of read across, if you like. Looking at some of the other individual names, we don't have Puma open yet. I think Adidas is open, perhaps. I might hold off on that one, though, but not showing much risk. Yes, up by just 0.4%, so not too much reaction to what maybe is seen by the markets as a bit more of an idiosyncratic Nike story.
I think you can park Nike at the moment. I don't think the numbers yet. I think the numbers out of China yesterday tell us something, but I think the broader kind of we are going to kitchen sink to a certain extent our numbers. We're going to withdraw guidance. I think feels, as you say, idiosyncratic, and we are waiting to see what the new management team delivers. So maybe that is an isolated case. But actually, I think to the point you've been making, there is a little bit of China read across this morning. We talked maybe earlier on about the fact that China feels isolated at the moment, doesn't feel like it's being impacted by the geopolitical story. But actually, maybe the London market brings those two narratives together.
Yeah, you're talking about the China story in the context of the stimulus that, of course, that we're expecting of China. But there's also the China overhang in terms of the car sector that we talked about earlier this week.
Yep.
That continuing to weigh on the German index, to your point, Anna, as well, because that, from just the early couple of minutes of trading, the DAX is the underperformer, and I would put Spain in there as well. So you are seeing that underperformance. There's a lot going on in the individual stock space. We should probably macro this out because, of course, we are still waiting for ADP data today, jobless claims tomorrow, and then, of course, payrolls on Friday as well. That puts the Fed firmly in focus. Larry Fink was speaking to Bloomberg from the Berlin Global Dialogue, saying the market is pricing in too many interest rate cuts from the Federal Reserve. Take a listen to what he had to say.
I think the forward curve is wrong. Okay. We're not going to see, and I think Chairman Powell said that yesterday. You know, we're going to be patient as we. I think the amount of easing that's in the forward curve is crazy. I mean, I do believe there's room for easing more, but not as much as the forward curve would indicate.
Joining us now for more insight, William Davies, the global CIO over at Columbia Threadneedle. William, a pleasure to have you on the program. Thank you for joining us around the table this morning. I don't think he's taking a very contrarian approach in that the market is perhaps overpricing interest rate cuts. But my question to you is, if the bond investors are thinking that way, how do you play it in other parts of the market?
Well, I'd start off by saying I think that Larry Fink is right in what he is saying. I think there's a lot of recentness bias over interest rates having been next to zero for a long period of time. And if we go back a couple of decades, then we would be used to interest rates much more positive or higher than they have been in the past couple of decades. So I think it's right that we are pricing, or markets are pricing in too many cuts as we move forward. Having said that, if we look at markets, I think it's dangerous to say that if we get those interest rate cuts and if we get sustainability of growth, even if it is slower growth than we have right now, actually that's not a bad environment for markets. If anything, it's the big reductions in rates and then maybe having to raise rates because we've gone too far. That would be something which I think would be a negative for markets, and particularly equity markets as well. And that is something that the Fed should guard against, having to reverse their cuts.
How much of the expectation of that dovishness, though, is priced into the equity market specifically? How much of that has been driving the green on the screen?
Well, I think if we look at equity markets, there's quite a lot of dovishness which is priced in because, if you look, for instance, at the S&P, up 25% last year, up 20% year to date this year. There's a lot of good news which is priced in there. But as I say, if we get that, if we get a slowdown in growth, but actually sustained growth as opposed to recession, then I think the market levels, there are risks out there, obviously, not just in interest rates, but that I think the level of the market is reasonable, but certainly we wouldn't expect the rises we've seen last year and in 24 to continue at a similar pace.
William, good morning. Can I ask you about your levels of excitement around the China story right now? As the global CIO, you know, you're weighing up region against region and thinking about where opportunities are. And we've heard a lot from China over the last couple of weeks, and it's lit some real excitement in some parts of the market. You can look at the Hang Seng, the Hong Kong Tech Index. You can look at the Chinese stocks listed specifically in Hong Kong. Where are you seeing room for this to carry on? Because this has been days and days and days now of substantial gains.
Hey, Anna, we're looking at extremes here. You know, we go back a few weeks, and is the Chinese equity market uninvestable, given the deterioration in economic growth, given the lack of momentum within the economy, and, of course, the tariffs as well. And then here we are. We get some stimulus. We get some stimulus in China, which is greater than the stimulus we've seen before. And then we see the rally that we've seen in Chinese equities, you know, up over 20%. Over the past week and a half or so. So I actually think it can go further than it is right now. But would we be supporting sustained outperformance in the Chinese equity market over the next few years? Be really careful about that, because if we look at that stimulus, it's more about stabilising the property market rather than anything else. We expect lower growth in China than we've been used to over recent years. So, yes, I see that catch-up. But in terms of extrapolating that over the next few years, I'll be really careful about that.
Right. I mean, is there something of a trap here that investors might fall into?
Trap.
Well, I mean, is it all done, I suppose, is all I mean?
Well, as
at risk of unwind.
I would say that it can go further as we get those short positions or underweight positions being neutralised. But I would say don't get sucked into believing that we will get rises of a similar nature going forward. So trap, I would say no, because we're going back. The market is cheap. So I don't necessarily see us going back to the lower levels, but excitement or overt excitement, I'll be wary about that.
What's going to outperform China going forward? What's going to outperform? Yeah, like if this is going to continue, which markets are going to outperform?
Well, I look at developed markets. I look at the US market. Even though valuations are high in the US market, right. It's the most dynamic economy. It has the broadest, most diverse.
But as you say, we've already had a massive rally. Hasn't all that already been priced in?
Yeah, but we would. It's interesting if you look at earnings this year. So people would say, well, let's look at 2025. We'd expect earnings estimates for 25 to be too high. As we've gone through 24, estimates for 25 earnings have actually risen during the year, which gives us confidence that actually we're going to make those earnings and potentially even surpass those earnings as we go into next year. So I think what we would say is do not expect those 20% or 25% returns that we've seen, but we do expect further positive returns as we move forward.
Is the market underpricing geopolitical risk?
I think that is a real risk for markets. I think that has been a risk over the last year. If we look at what is occurring, particularly in the Middle East at the moment, we'd have looked back to April, and we would look at the missile strikes from Iran then and say, are we underpricing geopolitical risk? Yes. But then the worst didn't occur thereafter. But I still think that there's absolutely a risk out there. Totally agree.
William, let's continue our tour around the world and bring it right here to Europe and talk about the hindrance in European equities right now in terms of seeing the same outperformance here that you're seeing in the U.S. What is the overhang, the biggest overhang in your view? Is it German weakness, the French deficit, the U.K.? Where do you see the biggest obstacle?
So I think if we look at Europe, the largest economy, Germany is really struggling to get out of next to no growth. I think we lack political leadership as well in Europe, with, if we go back a while, Merkel being the political leader within Europe.
Can you trade off that, though?
Well, we just say there's continued lower growth, disappointment within Europe. But you highlight one point there, Kriti, which I think is really important, and that is the deficits. The deficit in France that we're seeing around about 6% or so, and a weak government there they're putting through measures potentially to reduce that deficit, but will they get through? That remains to be seen. So I think there are real risks within Europe around that lack of political leadership and a weakness there. And we're starting to see, some of the more extreme parties do better. And so what does that bring about as we move forward?
All right, William Davies, Global CIO over at Columbia Threadneedle. We thank you so much. Guy, he makes a crucial point, which is, yes, the deficits are in focus, but can you trade off of them? Is this something that's priced in, say, the underperformance of the French index, among others, for example?
Look at what is happening, though, with the German market. The German market, record after record, despite the dismal economic performance we're seeing at the core of Europe. Talking of the core of Europe, let's take a look at the core 6 and figure out exactly what is happening with some of the big single stock names we watch here in Europe. As you can see, quite a lot of green on the screen this morning. Novo's up. LVMH is tracking higher. There may be some China read across, actually, in these markets this morning. Ferrari a bit soft. The car sector's under pressure. SML, Schneider, both positive. Nestle a little softer. That's the core. Let's talk about the single stock story more broadly. Joe Easton's here with the details.
So we are continuing to see some gains in the defence stocks following that news yesterday of the attack in the Middle East. We are, of course, waiting to see if there is any retaliation coming. We don't think at the moment there is a sign of that, but we are seeing strength again in Rheinmetall, Saab, BAE and Thales, all of the stocks that jumped late in yesterday's trading. So it's a second green day for those companies. And then in terms of some of the other sectors impacted by the geopolitics, we are, of course, continuing to look at those big oil stocks, BP and Total. Pretty impressive moves higher, given the 4% gain we've seen in crude futures since yesterday. So on a two-day basis, we're up 4%, and those stocks coming up, and airlines falling once again. Both of these stocks, IAG and Air France, were hammered in late trading, given the jump in the oil prices and the expected impact on airline fuel, on jet fuel. Air France was down 7% almost yesterday, down another 3% today. IAG was down 5%, down another 0.8%. So that continues to be a key theme for those markets. We've also got Pirelli, this one falling. Anna was discussing earlier, this is a big share sale. It is actually a company that is kind of a bit of a competitor in the auto parts makers sector, making brakes and that kind of thing. They're selling a big stake in Pirelli, though, the tyre maker. That is at a discount, so it is coming down around 3% today. Then a really interesting one to bring you is a stock called Wakakemi. Now, this is the best performer across the stock 600 in the opening trade. Now, there is a report that the US is looking to rein in solar imports from Asia, so trying to control that, according to a report out from Bloomberg. And this company, Wakakemi, does actually supply to that industry, so seeing a bit of a boost, potentially reducing the competition facing that company. It's a chemicals company that supplies to the solar space, that one getting a bit of a boost today. We've also got some decent broker moves to bring you as well. I like this one. Rio Tinto is upgraded at Berenberg. They say this has been the problem child of the mining assets over the past decade. They've got a long-term piece out on this today, but they reckon it's got the best cost base versus the likes of Anglo and BHP. So today they are upgrading Rio, saying that that is the best mining company to be buying at the moment. And then finally, banks. It's been a big couple of days for banking research. Yesterday we had Morgan Stanley downgrading European banks. Today we've got Barclays downgrading European banks, and also Exane BNP has a note out on the Nordics and saying that these stocks are also going to be a potential victim of declining rates. So they downgrade SEB, getting my SEBs mixed up. But they've also got a Nordea buy rating, so keep an eye on Nordea over in Finland and also Stockholm. But a couple of banks' research notes out this morning.
Thank you very much, Joe. Joe Easton from our equities team. We've had an eye on what's happening with Adidas and Puma as a result of what's going on at Nike. But let's also keep an eye on what's going on with JD Sports. This is a retailer of fashion based here in the UK. And we had news lines out from them earlier on, 7 o'clock UK time. We got some numbers from the business. They stuck to their guidance, but the stock is under pressure today. The analysts have actually not responded too negatively to the update, saying that the company was able to offer other brands away from the Nike weakness, but still the stock under pressure today. Coming up, we will focus more on Nike. It looks to wipe the slate clean for its new CEO, who is incoming. The company has withdrawn its full-year sales guidance, but is the sportswear giant doing enough to put its best foot forward? That story next. This is Bloomberg.
You mentioned the international strategy and the expansion from Adnoc's perspective. Before we dive into the details of that, I want to ask you a question that I think sparked in a lot of people's mind when they saw this deal cross the finish line, which is, why did the German government agree to this? And I ask this in the context of the fact that we have another major German deal that's seeing a lot of pushback from the government in the financial sector. Of course, UniCredit's stake in Commerzbank. Why do you think the German government said yes to this deal?
Well, for us, this is clearly a step change, transformative deal. It's a large deal. I think it's too early to say that all the approvals have been done. Today just marks a major milestone in our voluntary takeover offer. We are yet to go through the regulatory process, and that will take its own time after the voluntary takeover offer in the market. So I think we have great support from all the stakeholders in Germany. We believe in that market, but at the same time, we need to understand that Covestro is a truly global company. It has significant operations out of its 48 plants in North America, in Europe, as well as in Asia.
The head of Adnoc's downstream division, Khalid Salmin, talking about what that deal actually looks like and the fact that they pursued it for over a year. Yesterday, moved the shares just shy of 4%. This morning, seeing not as much movement in the stock. You are seeing it unchanged at the moment, down 0.4% in other markets as well. But, Guy, this was a question that you focused on yesterday, which is why the sudden friendliness in this industry, but maybe not in financial.
It seems weird, isn't it? Because Germany is an industrial economy. And chemicals are a core part of that. So you would have thought that if you were going to defend and be concerned about a particular area, it would be the industrial sector.
Yeah.
London's finance, you could argue Paris's finance, Frankfurt maybe a little bit as well. The banks don't seem to be so core to the German economy. Maybe you could argue it a different way, which is that ultimately the Mittelstand needs financing, and that's the reason why you would want to defend the banking sector. But it just seems slightly odd that you do have this very strong reaction to the Commerzbank takeover by an Italian business. And then we look at Covestro and a very different welcoming reaction, maybe from the German authorities.
Listening to Chad Thomas, who leads a lot of our coverage out of Western Europe, talking yesterday, he was reflecting that there is broader nervousness in Germany, and even the Adnoc executive you were talking to acknowledged that they haven't quite got all of the approvals yet. But you're right that the tone is really different. But Chad was saying there is general concern in Germany that even if some German assets aren't doing too badly, this is a time of weakness perhaps for the German story. And are they at risk of international buyers coming in all kinds of spaces to
UK's experiencing that.
The UK has certainly had that experience.
But this is a point that the Covestro CEO had made himself, that this is an industry and a company that needs a lot of fundraising. It needs a lot of investment. And I'm wondering if maybe the German government is giving a little bit of a blind eye to this, or is a bit more friendly or amenable to these negotiations because they need the fundraising. Can you say the same thing about Commerzbank?
It's folding the cards as well. Maybe you want to think about kind of how we should fold that into the conversation too. The Germans are taking a very strong line on this.
Yeah.
They want to protect the German auto industry. They're worried about the China exposure. They're taking a different line to the rest of Europe, you could argue. Fascinating to see the different approaches that are being taken in all these different industries.
At least Adidas is doing okay.
Adidas, yeah.
Talking of German businesses,
you want to talk about what is happening with the stripes versus the tick? Maybe we'll do that. Nike is facing one of its roughest patches in decades. Shares slumping in late trade. Sales missed estimates. It withdrew its guidance. Does any of this really matter? Yes, you're getting a fairly big reaction. Considering we've got a new CEO coming in, our consumer reporter, Dasha Afanasya, joining us now around the table. Why do I care about what Nike said yesterday? Why do I care about what they're doing at the moment? As far as I can tell, they're basically just saying, what's gone before, don't worry about it. What's about to happen is the thing you need to focus on. This felt like a kitchen sink moment that is clearing the path of the new management team.
I think that's what they want the market to take from this, that don't worry about this, it's all new now. But there was quite a lot of detail that will give investors, a sense of the scale of the turnaround that has to happen, that maybe is a bit scary. So I think that the headline numbers are perhaps neither here nor there. And the guidance, obviously, we always see this, new CEOs coming in, cancelling guidance, because why should they have to be held to what their predecessor has set? But I think in the detail, there are a few things that give you an idea of how much more tough times there are ahead. So, for example, the company spoke of the declines in Air Jordans and Dunks and Air Force Ones as a good thing. They said, this is declining more than the overall 10% sales decline because we're actually reducing the supply because we don't want to be reliant on that because we don't want, they're not doing very well. But the problem is that other parts of the business and things they've tried to kickstart, for example, the running business, which has grown 4 times in the last year with models such as Vimero 5 and Y2K, it's not making up the difference. So it sort of raises the question of what can an incomer do? And we know that it's a long, tough slog ahead because the other big aspect of this is rebuilding these relationships that they burnt with retailers, which is a human thing, isn't it?
Yes, so certainly that very much part of the story, and maybe they're sort of turning the tide on that narrative. One area of brightness does seem to be what they're doing in China. I mean, I say brightness, I think sales still declined, but not as much as people had expected. How much do we read into that, Dasha?
Yeah, so the other competitors such as Anta and Adidas are actually up on the news because China's slump has been dragging down the whole consumer goods sector, but particularly apparel luxury. So there are a lot of questions on this in the analyst call. But I did think it was interesting, Nike saying we're still below what we want to do there, and we're still below what we planned. But we know we can read across to other companies that maybe things are getting a tiny bit better.
You mentioned that keyword, the read across. Talk to us about what that impact looks like in Adidas and JD Sports, etc.
Well, I think we're seeing that it's a Nike-specific problem. There are specific things that Nike did wrong, particularly with the retailers and particularly with not managing the supply of certain shoes very well, and also not spotting trends and resting on their laurels in terms of not seeing these specialist retailers such as On that have been taking market share like crazy. And that's why, you know, there was concern that JD Sports, which is one of the retailers that was still holding Nike shoes, would decline and would suffer because of the Nike slowdown. But it beat expectations today, so we are still spending on sportswear.
Certainly something we're going to be keeping a very close eye on. Bloomberg's consumer reporter Dasha Afanasieva joining us around the table this morning to bring us the Nike story and, of course, the read across into European consumer companies as well. Coming up on the program, we go back to the Middle East. Israel promising a retaliatory attack on Iran. We discuss the latest developments in the Middle Eastern conflict. The director of the Middle East and North Africa program at the European Council on Foreign Relations will join us next. He's had a industrious career, of course, in journalism, but living in several of these regions that are certainly affected. We're also keeping an eye on the latest warnings coming out of southern Lebanon and, of course, live pictures coming out of Beirut as well. We're going to keep you apprised of the conversation and the risks around further escalation from both sides. Stick with us. This is Bloomberg.
Welcome back to the programme. 8:30 here in London. Israel's Prime Minister Benjamin Netanyahu has vowed to retaliate after Iran fired 200 ballistic missiles at the country last night. The barrage started only hours after the US warned an attack was imminent. The Israeli army says many missiles have been intercepted, with reports one person was killed in the West Bank.
Iran made a big mistake tonight, and it will pay for it. The regime in Iran does not understand our determination to defend ourselves and our determination to retaliate against our enemies.
The Revolutionary Guard and Iran's armed forces are ready both defensively and offensively to repeat this operation with multiplied intensity.
Let's get more with Bloomberg Horizon's Middle East and Africa anchor, Jemana Basetchi, who can give us an update. Jemana, I guess we watch now, having heard the words of the Israeli leadership, we watch to see how Israel responds.
That's exactly it. So this is yet another escalation in the Middle East conflict, and it's also the second time Iran has gone for a direct attack on Israel. What we know is around 7:30 p.m. local time yesterday, around 200 ballistic missiles were fired directly from Iran into Israel. Explosions were heard around the country, but the IDF say most of those missiles were intercepted, causing limited damage. There was one person who was reported to have been killed in the West Bank, but that was on back of shrapnel exploding, and they reported 2 other casualties as well cited within Israel. Now, of course, this response from Iran has been anticipated. They've been warning for a month now, over a month now, that they would exact retaliation and go for some sort of revenge attack on Israel to the killing of Ismail Haniyeh, as alongside the most recent killings of Hassan Nasrallah and a senior IRGC commander who was taken out in an airstrike in Beirut last week. And so the retaliation has come now. And in terms of the degree of the intensification, a few experts are pointing out a couple of features that are specific to this attack that differentiate it from what happened in April. The first is this time around it was less telegraphed, so there was less time for the Israeli defense system to be up and running in order to intercept those missiles that came through. But of course, many of them were actually intercepted in the end. The second point worth noting is that these types of missiles were more long range and specific and faster than the ones that were used back in April. Those were slower moving missiles. There were also drones that were easier to intercept back then. And so those distinguishing features tell you that Iran, in their own way, have chosen to intensify, even though in this case there was no guarantee, of course, of any civilian casualties. But it does mark an escalation point, of course. And key from here is how Israel chooses to respond. Many reports coming earlier from Axios saying that Israel would respond and retaliate in the coming days, and that it would be a significant retaliation. And of course, one way that this could get even further escalated is if they choose to target potential energy infrastructure sites in Iran, or even go one step further and target nuclear sites too. So all of this is up in the air, which is why you are actually seeing for once quite a significant impact on some of these global markets, oil markets this morning.
Yes, absolutely. Just as you're speaking there, and maybe markets are thinking about the substantial potential nature of any Israeli response, and we are seeing oil prices now up by 2.4% just this morning after yesterday's rally. Bloomberg Horizons Middle East and Africa anchor Jumana Basechi, thank you very much for setting up our next conversation. Joining us now, Julian Barnes-Dacey, Director of the Middle East and North Africa Programme at the European Council on Foreign Relations. Julian, so very good to have your thoughts on the programme and your insights. Picking up where we left off with Jumana there, a lot of people are trying to think about what Israel's reaction function might look like here. Do you have any sense of what a significant response might look like?
Good morning. I think we're all playing a guessing game here, but the Israelis have made clear that they are going to respond much more forcefully than they did to the April attacks. And there have reportedly been already some kind of back-channel communications leading up to the latest attack, whereby Israel warned the Iranians that any new attacks would lead to Israeli strikes on energy production sites and potentially also nuclear sites. And I think the Iranians have in kind also suggested that if that happens, they will target wider regional energy sites to try and knock wider supplies offline, noting in their mind that they view kind of the Gulf platforms of energy as being very much interlinked with the US regional posture here, which is backing up the Israelis. So clearly, we're at a grave kind of escalatory moment here. The Israelis are going to respond, and there is a real risk that will push the Iranians to do something else in kind in turn.
Yes, we're jumping ahead a few reactions here, Julian, but interesting to explore how Iran then would respond and what kind or whose energy assets they could target if that's the case. Because I know you've written substantially about the relationship between Iran and Saudi Arabia, and how even if it's been strained, it has been perhaps moving in the right direction, and that could be the secret to some progress here.
So on the one hand, the Iranians have made a big effort over the last 18 months to renew their ties with the Arab Gulf states. They've really kind of engaged in new dialogue. They've mended fences. So on the one hand, they are wary of alienating their regional partners. This is their escape route to get out of or to maneuver around Western sanctions, to build out their economic trade, to ensure that actually these countries can't be a platform for attacks on Iran. On the other hand, that's one of their few kind of deterrence measures, which is that they can say to the West, to the world, to President Biden ahead of the upcoming election, that if we're hit, that if you allow Israel to target our energy supplies, well, you better expect a wider impact on global energy supplies, because we can actually then knock out energy supplies in the neighborhood as well. So I don't think they want to attack their partners. I think they want to use those relationships to actually build out their economic ties and capabilities. But they are now in a defensive mode. They now know that this is one of their few elements of deterrence left. And as they try and push back against a new Israeli attack from their energy facilities, that's one card that they have left to play. We don't know whether they would do that, because if they did that, they would certainly alienate the entire region against them at a moment when actually the region is helping them, where you have countries like Saudi Arabia engaged in dialogue, trying to de-escalate the situation. But clearly it's a risk that is hanging out there, and obviously the hardliners in Iran are going to be much more aggressively pushing a position that they think is needed to safeguard their position here.
Julian, how weak do those hardliners look domestically right now? How undermined is the administration in Tehran by what is going on here?
Well, clearly they're significantly on the back foot. And I think last night's attacks were partly a response to that. We've seen Iran and its allies take hit after hit after hit across the region. And even after the killing of Hassan Nasrallah last week, the initial response from more reformist, moderate-leaning elements of the government was to say, take it in, don't respond. And you saw a groundswell of hardline reaction, aggressive responses to that within the Iranian system that I think pushed the supreme leader to take a more assertive stance. And the hardliners were essentially saying to Khamenei that if you don't respond now, the Israelis will just keep on coming after us, and there'll be nothing to stop them actually launching wider attacks on our allies and on Tehran itself. So the attack last night, although not as telegraphed as the attacks in April, was still telegraphed. The Iranians have come out since last night saying, we're prepared to end it here. We can draw a line. We don't want to take it further. So they're trying to prevent a wider cycle of escalation now, but things are out of control to a certain extent, and the Israelis will respond.
But how deterred are the Israelis right now? I'm wondering. The Iranians have launched attacks on Israel to little effect, and I'm wondering, therefore, how effective the deterrence is. Hezbollah has been neutralised in a way that we did not anticipate. The missile strikes, the ballistic missile strikes, are largely being intercepted. How big a deterrence are we seeing here from Iran? How deterred is Tel Aviv?
Well, I mean, my sense is that there's a danger of a strong degree of overconfidence in Israel at the moment. Clearly, they've hit Iran and its allies quite bad, but we had an unprecedented show last night of 200-plus ballistic missiles being fired on Israel. A lot more of those got through, I think, than we're really noting today. And obviously, the kind of Israeli media and military keep those details quite under wrap. We saw that in the April attacks, we were told that nothing got through, and in the end, we found out that a couple of Israeli military sites were actually hit. We also know that Hezbollah has an arsenal of about 150,000 missiles at its disposal, and they have not been using the more aggressive, high-impact missiles since over the last year. They've been holding those back because they and the Iranians have been trying to play a game of showing some support for Hamas, but not actually pushing the Israelis into a full-blown war. And so I think the risk is the Israelis feel confident here. They feel that the Israelis and Hezbollah aren't doing much to them. But actually that pushes the Iranians and the Hezbollah to engage in the kind of steps which would be a prelude to full-blown war and which would pose a much more significant cost on Israel itself, including the firing of missiles that could actually cause much more damage on the ground.
Julian Kriti in London, we are getting some images from last night out of Beirut, and we're talking simply about what those evacuation plans look like in the south of Lebanon, but also within Beirut itself. You mentioned the Hezbollah story, and I'm curious from a perspective of a regional escalation and a wider conflict. I recognize that the epicenter is, of course, between Israel and Iran, but how much of a role does Lebanon play right now in terms of these, of course, on your screen, the live images of Beirut?
Well, Lebanon's critical. I mean, Lebanon is one of the tipping points. You could see this erupting through direct clashes between Iran and Israel, but it's just as likely to erupt in Lebanon in terms of the Israelis launching a more full-on land incursion, moving up towards the Litani River, bombing Beirut, and that could provoke a more full-hearted Hezbollah response. As I say, they have not used the full power of their arsenal of missiles to date. it could also draw in Iran to offer more full-hearted support for Hezbollah, its key regional ally. So these are two theaters that are both part of the same conflict. Each could act as a tipping point. Iran and Hezbollah do not seem to want a larger regional war at the moment. Israel is talking about the opportunity to remake the regional system. They see this as an unprecedented opportunity to push the Iranians aside. And, sadly, I should say that we've seen these kind of illusions frequently over the last 25 years, since 9/11, frankly, and they've repeatedly made the region much more violent and created outcomes much more disastrous than where we started. So I think we should be very worried about these hubristic illusions that one could potentially knock aside the Iranians and remake a pro-Israeli order at this moment.
Julian, you're joining us from the European Council of Foreign Relations. So let's bring the conversation back to Europe's role in what's going on in the Middle East. Do they have a role when all eyes right now are on the United States' part and policies towards both Iran and Israel? Where does Europe step in or don't in this conflict?
So the Europeans have been irrelevant. They have been completely out of the conversation. They haven't made an impact. A key dimension of that has been their inability to have a coherent position on what's happening in Gaza and that conflict. I think it's been quite clear for quite some time that the only way to prevent this wider explosion is to get a ceasefire in Gaza. There have been numerous ceasefires on the table, and frankly, it's been the Israelis who have repeatedly rejected that, Prime Minister Netanyahu. And the Europeans have failed to put pressure on the Israeli government to move towards that ceasefire, even as they've rightly put pressure on the Iranians, increased sanctions, and so forth. I think at this moment, the key role lies with the Americans. Can they put pressure on Israel to control their response? And the answer seems to be no for the moment. There were reports coming out of Washington yesterday that Biden's Middle East advisors are very much behind the Israeli offensive, believing that this can be the moment to reorder the region. And I think the question for the Europeans, much like the Arab Gulf states, is are they capable and willing to take a strong message to Washington, D.C. at the moment that this is a hugely dangerous moment and that has to be prevented, and that the Americans need to lean in heavily on the Israelis and use their outreach with the Iranians to contain the situation. What the Europeans don't have the ability to do is to impose that solution on regional actors because they are out of the game in terms of influence and leverage on the ground.
Within the IR community, what is the expectation as to how good Israeli intelligence is right now? Clearly what happened in Gaza was a huge blow for Israeli intelligence. What has happened, though, in Lebanon has reasserted the idea that the Israelis do know what's going on in the region. How good is the expectation surrounding Israel's intelligence as to what is happening in Iran and the specificity required to make targeted strikes against the nuclear program?
So I think clearly we've had a demonstration of the absolute quality and advances of the Israeli intelligence network across Iran and its allies. The decapitation of Hezbollah is really a remarkable tactical success. There have been reports coming out of Iran in just the last few days that Mossad has even penetrated the anti-Mossad penetration unit of the Iranian system. I mean, they've penetrated the spies who are trying to root out the spies, so to speak. So I think one can assume that the Israelis have extremely good intelligence, extremely good access, and can continue to impose very significant hits on Iran and its allies. But what they don't seem to have is a strategic plan here. They don't seem to have a political vision or horizon that actually gives them an off-ramp. And I think we've seen that in Gaza, we're seeing that in Lebanon. Israel can hit Iran and its allies in Gaza and Hamas militarily in very emphatic ways. They are unable to create a situation that allows them to guarantee their security demands in a sustainable way. Even if they take Hezbollah back to Beirut, Hezbollah will keep being able to fire stray missiles on northern Israel that will prevent Israelis moving back into the north of the country, which is the declared aim of this incursion. So I think Israel really needs to ask itself, what is the off-ramp here? How and what are we prepared to do to get a ceasefire in Gaza that creates the conditions for regional actors to stand down? And for the moment, the only kind of strategic outlook seems to be what Netanyahu was talking about in the UN Secretary General Assembly last week, a great reordering of the Middle East. And as I say, we see that kind of dangerous planning on multiple occasions over recent decades, and it's never ended well.
Julian Barnes-Dacey will leave it there, Director of the Middle East and North Africa Program over at the European Council on Foreign Relations. We thank you so much. Coming up later in the program, Bloomberg's Stephanie Flanders will be hosting a panel with the French President Emmanuel Macron at the Berlin Global Dialogue. More on what to expect from that conversation and the governments in Europe next. This is Bloomberg.
50 minutes into the session, this is what European equities look like. Reasonably calm session thus far. In terms of the sector story below the surface, energy, basic materials and the luxury sector are really where we are seeing the gains here this morning, particularly on the energy front, up by 2.35%. Weakness in real estate, utilities and telecoms, the kind of sectors that get moved around by the rate story. Let's talk about what is happening with Europe's political narrative and where it goes next. And the divisions we are seeing, Chancellor Olaf Scholz, as chief economic advisor, is concerned about Germany's economic growth. Understandably. Bloomberg's Francine Lacroix sat down with Jörg Kukies at the Berlin Global Dialogue for an exclusive interview.
It's definitely too low. We are struggling to get positive growth this year. But the more fundamental problem is that we don't only have a cyclical growth issue, we also have a structural growth issue where our growth potential has declined from 2% at the beginning of the century to 0.5% currently. So we're doing everything we can to not only deal with the cyclical issues of energy prices and reducing red tape, but also going at the structural problems like attracting skilled labor to our country.
But so we had a Bloomberg scoop on Monday saying that basically the next German government projection for growth will be flatlined. Is that the case? Can you confirm that?
Well, we have the predictions coming up in a few weeks, so I can't talk yet about them, but I can tell you, you will find out soon what our most current projection is. But I think when you see all of the economists around, it doesn't take a lot of imagination to predict that it will not be a very satisfactory high growth rate.
So you mentioned some of what's the underlying causes of the slower than expected growth. What are the priorities for the government to kickstart growth again?
So we just launched a growth initiative where we have in the key pillars the structural elements that we need to fix. On the one side, incentives for investment and research on the taxation side. On the other side, incentives to attract talent and skilled labor from the rest of the world to come to Germany and to mobilize more of our labor potential within our country. Then there is a big chapter on energy and how we increase the supply of energy to reduce cost, how we invest in billions and even hundreds of billions into the grid to transport all of the newly created energy. So in that sense, we're really going to the core of these structural problems. The last point probably to mention is that we are also accelerating planning and permissioning. We did that with the LNG terminals. We're doing that with renewable energy, with grids, with highways, with railroads. So all of the infrastructure investment is also being accelerated.
How quickly do you think that can turn around things?
Well, of course, structural reforms always take a bit of time to work, but we are predicting an increase in our growth potential by 0.4% as early as next year.
Jörg Kukies, Chief Economic Advisor to Chancellor Olaf Scholz in Germany, speaking to Francine at the Berlin Global Dialogue yesterday. Germany is struggling. France is struggling. In France yesterday, we also saw the new French Prime Minister Michel Barnier outlining his targets for where debt deficits are going to be going here. He's not going to meet the target of 2027 to get the deficit down to 3%. It's going to be 2029. We're expecting more details, obviously, from the economic picture to emerge over the next few days. I think we could get a pretty big heads up today because Bloomberg's head of economics, Stephanie Flanders, is going to be moderating a panel with the French President Emmanuel Macron. Stephanie joins us now ahead of that. Stephanie, Michel Barnier was outlining tax hikes yesterday for French business. Is the Macron economic experiment firmly coming to an end?
Well, I mean, that's the kind of question I will be asking him this afternoon, because you have to remember, you know, when he came in 7 years ago, you remember at Davos, he talked about France is back. I mean, it just doesn't feel like that today when you look at, you know, the spreads on between French and German bonds higher than it's been since he's been president, and a lot of question marks about the fiscal situation, which has just continued to deteriorate. You have a nearly 6% of GDP budget deficit this year, and as you mentioned, a new government that's delaying or taking, you know, was managing to sort of sound credible with some kind of plan yesterday, but we know politically in a very weak spot. You know, when governments have to make difficult decisions, you kind of hope that they have a mandate and that they have, you know, the kind of parliamentary strength you need to get these things through. And Michel Barnier has anything but that, thanks to the disastrous decision to call that election in June.
Stephanie, I also know, making news near where you are, China EV tariffs. That's much talked about, generally in German business, I'm sure, but specifically at this forum, perhaps.
Yes, and we had... You'll remember that a year ago I spoke to Chancellor Scholz at this panel, and he said he really didn't want a trade war. We've now got a vote on Friday, EU governments voting for whether those tariffs on Chinese electric vehicles in Europe are going to be passed. And you know, we don't know whether there's going to be any agreement between the French and the Germans on that, but we're going to hear more later, I think.
Certainly something we're keeping an eye on. Stephanie Flanders of Bloomberg Economics, of course, joining us out of Berlin. You can catch her exclusive panel with the French President Emmanuel Macron just after 2 p.m. UK time, of course, live right here on Bloomberg Television. Plenty to watch in the day ahead. You are seeing plenty of data, of course, at 10 a.m. UK time in just about an hour. Euro area unemployment, plenty of data over in the States as well, 115 U.S. ADP, but also plenty of central bank speak from both sides of the Atlantic. The Fed, the ECB, all hitting the wire. In the meantime, European markets, about an hour into trading, are trading in the green. How long does that last? We'll have to find out. That does it for the opening trade. The Pulse is up next. This is Bloomberg.